Okay, so I started the recording button. I keep forgetting. And the people who requested me the recording, they are already here. I don't know who I will send this recording. The two ladies are here. So sorry. Finally, okay. So two topics. One is the stock split, another one the analysis of the stocks. So stock split and its effect on option prices, and the analyzing last week's stocks. So let me open this presentation. Okay, so stock splits effect on option prices. So when the stock split, I'll explain the reason why the stock splits. What is a stock split? What are the different phases of a stock split? And the various scenarios of the stock split and its effect on option prices, because we trade options. So I want to explain that. So a lot of you are aware of it and some of you may not. So I just prepared this last night. I thought, okay, I can explain this. So a stock split effect on option prices. So what is a stock split? A stock split is the action a company takes that increases the number of its outstanding shares by dividing each share. So it's simply increase of the outstanding shares based on the stock split. So if the company has 1 million outstanding shares and they announce 2 for 1, the outstanding shares become 2 million. So from 1 million become 2 million shares. And if the price is $100 before stock split, the price becomes $50. So the value remains the same, but the price goes down and the outstanding shares increases. So that's what happened to stock split. So example of a stock split. So before the company announced a stock split, or before the stock split happened, there were 1 million shares and the price was $70. So suppose a split is going to take tomorrow. So today the stock is trading at $70 and they have 1 million outstanding shares. If they declare 2 for 1 stock split, then after the stock split there will be 2 million shares, because for each share you get 2 shares. So you give 1 shares and you get 2, and the price drops to $35. So nothing happens to your position. So before you had $70, after split you have $70 worth of investment. So nothing happens. But something happens, so positive things when the stock split announced is positive, considered as positive. So the reason for stock split is psychology and the stock's liquidity. So when this company is making good progress or having a good revenue, good products, there is a positive psychology going on for the stock, and the stock keeps going up and becomes expensive. So for instance, Amazon becomes expensive, $1,000. So a lot of retail investors, they cannot buy Amazon because to buy 1 share costs $1,000. But if the Amazon is split 10 to 1, then the price will drop to 100, and now people can buy Amazon shares. So stocks, the purpose also is the stock liquidity. So stock liquidity and the psychology plays the role in the reason for stock split. So most common stock split as 2 for 1, 3 for 1, 3 for 2, 4 for 1. So if you have 1 share, you will get 2 shares. If you have 1 share, you will get 3. If you have 1, you will get 4. This one is a little complicated, 3 for 2. So I'll explain the formula and how it works out. 3 for 2. 3 for 2 means if you have 100 shares, you will have 150 shares. So that's the formula. So the others are simple, but sometimes it gets complicated. So So how you calculate how many shares you will have and what will be the effect on the option price. So that's the purpose. So there are 6 phases of stock split, and I'll explain a little more besides these 6 points. So there's a phase called pre-announcement, then there's announcement, then there's dormancy, then a pre-split run, and then a split execution, and then post-split depression. So pre-announcement, so before the announcement is made for the stock split, traders get the rumor that the company is going to announce the stock split. So there's some positive things going on. And if you remember Apple, when they did the stock split, so people get the idea, the news are leaked, and the stock starts moving up. So before the announcement is even made, the stocks moves up. So something is going on. So if there is a rumor, the stock goes up. And if the stock is solid based on the product or services they are providing, then comes the actual announcement. So there was a rumor, and then the actual announcement came. So on the announcement, like during earning announcement, they also announce a stock split. So the earnings were positive, and then the stock was moving, and then they say, okay, we will announce 2-for-1 stock split. The stocks move up further. So if the stock is good and the stock split is announced, it's further good for the stock. So those the people who bought on a pre-announcement, they are buying more on the announcement, or those traders who wanted to wait for the actual announcement, so they jump in and they move the stock higher. So the stock split is usually a positive thing for the company. So after the announcement is made, on the announcement, they say they give you the date, that till that date, whoever holds this many shares, or this is the record date. If you hold shares on such and such date, you are eligible for stock split. And then there is a split date. So on that date, the stock is split, and then the next day the stock opens, which is X split date. And on that date, the stock is split according to the split ratio, and start trading at the split price. And if the company is solid, people tend to make money. The traders make money even when the stock is split and start trading, because more retail buyers come in. So suppose Amazon is 1,000 and the retail traders cannot buy, and it splits 10-1. Now it's trading at $100. So the retail money comes in. So if you own 1 share of Amazon, now you own 10 shares of Amazon. So basically your price should be this, your investment should be same. For suppose it was trading at 1,000, now you have 10 shares, it starts trading at $10. So your investment should be the same. But it could be that Amazon starts trading at 100, 101, 102. So you have 10 shares and the stock is going up. So it's like Amazon is going from 1,000 to 1,050, 1,100, like that. So your value is going up because of the retail participation. More traders can afford. Then there comes a, so after the announcement, there is a dormancy period. So those who bought, they bought. And then the stock just moves on the sideways action. So this is the period where there is not much move. Then come the pre-split run. So pre-split run means just before the stock is about to split. So let's say tomorrow or the day after tomorrow, 2-3 days before, the stock takes another move up, and traders chase the stock. So this is another period where this stock is about to split and traders come in and start chasing. Maybe the people who took, traders who bought the stock here pre-announcement, and then some bought an announcement, now they took the profit in this period, dormancy period. So the stock has come down. So for instance, is at the pullback. Now further fuel, so they come and then they start buying up. So other professionals, they come and buy. Now the split happens, so split execution. So on the day the split happens, the stock price is reduced and there are more shares, so more retail traders come in and they buy, so the price goes up. Then the final phase is the post-split depression. So after a week or so, everybody has settled. Those who wanted to buy, and those who wanted to take profit, they took the profit. The stock goes on the sideways action. Sometimes the stock goes back to its pre-split price faster than the other stocks. So there are some stocks which move fast and go back to the pre-split price. So for instance, Amazon. So Amazon, suppose they announce a 2-for-1 split. So Amazon drops from 1,000 to 500, and then it's trading at 500. Now you have 2 shares, and then you will see, suppose this is just an example, that the stock starts moving towards $1,000, and in 2-3 years, or maybe less, 18 months, that's what they say, that usually it takes 18 months or 2 years, the stock goes back to the pre-split price. So let's say the Amazon is split into 2, 500, and then it starts inching up and goes back to $1,000. So if you had 1 share at 1,000, now you have 2 shares at 1,000. So your investment doubled. So it happens. Okay, next. So how stock split affects options? Because we trade options, so we understand how the stock splits affect the option. So I took the example. This is a real example I took for CRM. So stock is CRM, and the date of the announcement was on March 21st, 2013, and they announced 4-for-1 stock split, and the date of split was on April 18, 2013. So announcement was on March 21st, and a split will take place on 18th. So all the pre-announcement, announcement, and pre-split run is during this phase, right? Then the date of split. So if outstanding shares before the stock split was $400 million, 400 million shares. So there were 400 million shares outstanding. After the stock split, there were 1.5 billion shares outstanding, because 4-for-1 stock split. So if you had 1 share, you got 4 shares. And the price on April 17, 2013 was $170 per share. So if you had 1 share at $170, you would have 4 shares at $42.50. So imagine the next day you open your account, you will say, if you had 100 shares, you will say, oh wow, I have 400 shares. And then if you don't know anything about the split happened, you will say, oh, I got 400. Or you may see the price $42.50, then you will say, what the hell happened? The Amazon, CRM dropped to $42.50. And you may end up selling or taking action which you were not supposed to. Panic. You see from 170 to 42.50, but you're not seeing that you have, instead of 100 shares, you have 400 shares. Instead of 1 contract, you have 4 contracts. So that's you have to be aware of. So the price will go to 42.50, and you will have, instead of 100 shares, you will have 400 shares. Then the CRM can trade up. So from 42.50 it goes to, suppose, 50. So you're making money, or it can go down. So before a stock split, if you had 1 contract of May 170 calls, price of option before stock split was $8. So let's say you bought 1 contract May 170 at $8. After stock split, you will have 4 contracts of May 42.50 calls, and the price, they will open at $2. So the CRM will open at $2, and you will see 4 contracts. And if you look at the option chain, these contracts will have their own separate the what is it, the option symbols. So different, it's called non-standard, so it will be non-standard. And 4250 strike, you will see various strikes: 4250, 40, 50, 4750, all these strikes. And you will have 4 contracts. And if CRM goes from 4250 to upside, then your $2 will go to 250 to 60, etc. It will appreciate. So this is what you have to understand. So so that was simple, right? So suppose 4 for 1. So 4 for 1, 2 for 1, 10 for 1. It's very simple. So if you have 100 shares, 10 for 1, you will have 1,000. If you have 2 for 1, if you have 100 shares, you will have 200 shares. But then the complication begins. Sometimes they announce some weird numbers, and these are not a whole like integrals. They say, okay, it's 3 for 2. So 3 for 2 means what? So let me explain. So before stock split, suppose they announce a split 3 for 2. So before stock split, you own 100 shares. Price before stock split was $600, $60. So your investment was $6,000. So you bought 100 shares at $60. Your investment is $6,000, right? So, and they announced 3 for 2 stock split. So after a split adjustment, when the split happens 3 for 2, what would happen? So this is the formula. So your original shares divided by 2. So you take you want a common denominator. So 2. So 100, 3 for 2, you divide by 2, and then you multiply by 3. So you will have 150 shares. So after stock split, instead of 100, you will have 150 shares. And because you have 150 shares and your investment was 6,000, so what should be the price per share? So it will open at $40. So your investment will remain same. 150 shares, you will own 150 shares at $40. So your investment will be 6,000. Now if it goes to 41, 42, your investment will go from 6,000 to higher price. So that's the reason, so you have to do your calculation and make sure that you have the correct number of shares. So now is 150 shares. So this is because we know that each contract, option contract, one contract holds 100 shares. Now this one is 150. So your option is chain. There will be a different option chain. So one contract will hold 150 shares, and they will continue to do that till the option expiry period. So when the option expiry period is over, then you will no longer see those special option chains. So sometimes you will see non-standard. So you have to see the prices will be higher for that option. So you have to see, okay, how much one contract is I'm holding 150 shares or what, 200. So if you see non-standard, then you have to 150, 175, whatever. So you have to, when you see non-standard, you have to either stay away or find out what's going on. So let's explain the option pricing. So example of stock split adjustment on options. So a stock is CRM, stock split 3 for 1. No, it should be 3 for 2. I made a mistake. The ratio is 3 for 2. Otherwise, it's simple. So stock split is 3 for 2, like we were talking. So you're holding one contract of June 60 calls. So value of one contract before split. So one option contract, you can buy 100 shares, right? And it's 60 strike. So you have the right to buy the CRM at $60. So $6,000 is your value of that contract. After the stock split, you will have a 40 strike and one contract which will be holding, you have the right to buy 150 shares. So again, the value of your value of your contract will still remain the same, 6,000. So there's no effect. It's just that now you will your one contract is they will reduce the strike to 40. So you will see 40 strike, and it will be you're entitled for 150 shares. So that's what you have to remember. And non-standard chain, sometimes you will see. And there's more to the stock split. There's a reverse split, etc. So maybe I'll cover some other time. And if you want to find out more about the stock split information, which stock is being split, this is the Yahoo Finance address. So you can go to this address, or simply go to Yahoo Finance and type stock split, and you will come to this address. It's http://biz.yahoo.com/c/s.html. So you can write it down, or just simply go to Yahoo Finance and you can do your research. So let me recap. So what is stock split? Stock split is simply the increase in number of outstanding shares. There is a reverse stock split where they reverse. So if there's a 10-to-1 reverse, or 1-to-10, so if you have 10 shares, you will have only 1 shares, and your value of that share will go up 10 times. So so a stock split increases the number of outstanding shares. An example of a stock split: if you have 1 million shares the company has and it's trading at $70, the company will have 2 million shares, and stock split price will be $35 per share. The reason for stock split is psychology and the stock's liquidity. They want to increase the liquidity in the market so the retailers can participate. There's more interest in the stock. The stock become expensive, so to do that, and the trading, it's good for trading if it's a price is a low price stock instead of a high price stock. So all that encourages the company to do the stock split as a positive publicity for the stock. The common stock split is 2-for-1. We discussed that. 3-for-1, 3-for-2. We gave you the example of 3-for-2, 4-for-1, 10-for-1. These are the 6 phases of a stock split. The pre-announcement, where traders get the rumor that there is a stock split coming up, and the stock starts moving in anticipation of a stock split. If it's a good stock like Apple, Facebook, etc., Amazon, Google, and then the actual announcement takes place, and they announce the date when the stock split will take place and what will be the stock split, etc. Then there is a dormancy, so the stock moves up on announcement, or it may not move, so it depends. Then there is a dormancy period where the stock is doing nothing, just on the side because all the buyers are in. Then the pre-split run, so the final run before the stock split, like 2 days or 3 days before. Then the date of the announcement, so split execution. So a split happens, and then the stock is trading at lower price, and the retailers are in. And then the post-split depression, after the split happens and it subsides and a week has gone by, now the stock is trading just normal, it's doing nothing. So these are the 6 phases and effects of the stock split. So I gave you example 4-for-1. So if you had 400 million shares, it became 1.5 billion. If it was trading at 170, it would trade at 42.50. If your calls was at $8, it would be at $2, and strike will be divided into 4. So 170 strike will become 42.50 strike, and you will have a separate chain. Standard for non-standard split, like 3-for-2. So 3-for-2 stock split, they call it adjustment. So 3-for-2 is if you own 100 shares, you will have 150 shares. So you will have 150 shares, and the value of those 150 shares will remain the same before this, what it was before the split, just before the split. And after the split, so $40. So your investment will be $6,000. So this is the example I gave on options, and you can find it on Yahoo Finance. So this was introduction to split. Now I'll explain some charts. So let me close this. So I covered this stock split topic, now analyzing the last week's stocks, and I will explain the reason for entering in the trade. So as I said before in my previous presentation, there are certain patterns where the professionals come in, and they come in that moment, and so I try to analyze why the stock is moving at this time when it's so beaten down, or stock is coming down when it's so up. So what is the reason? So there's certain chart pattern, and we can detect the moves of the professionals, and I will give you some charts, show you. So fortune is made by mastering few techniques. We don't need to master a lot of techniques. We just focus on 5, 6, 10 techniques, and then just repeat those techniques. Every day there is something going on, and if you have, suppose, 10 techniques, you will find 1 or 2 stocks which fits in that technique. So as Bruce Lee said, that I fear not the man who has practiced 10,000 kick once, because he is a master of he has practiced 10,000 kicks, so he's not master of anything. But I fear the man who has practiced 1 kick 10,000 times. So this is Bruce Lee saying, so you need to master 1 kick 10,000 times. So when you apply that kick, you know, person like my uncle, I was explaining, my maternal uncle who brought me up, he was a one-eyed man. Later he became blind. He was very thin, and he owned like he was in transportation business along with his brothers, and he had farms, and he had a lot of enemies in this business back then. So he told me one time that, Naushik, if you come into a fight with a guy who's 4 or 5 times bigger than you, don't try to avoid the fight. Don't get into physical, and try to avoid it. But if you get into the fight and you have no choice in a life or death, then you will get only one chance to survive. So that one chance should be so perfect that you bring that big guy down, and that's your chance to survive. If you fail in that one chance, then you will die. So people, you know, at that time, people still, they do physical, you know, fight, man to man. There was no gun, nothing, just man to man. So that's what my uncle gave me advice: master one thing, one technique, and bring the big guy down. So master the techniques which produces high and fast return. So in option trading, it's all about return and fast. So how many times we can repeat. So there are techniques which, or the patterns which, if we see that pattern repeating and there is a momentum behind, then the return is high. So some of the techniques which I follow is a breakout strategy, because the stock is breaking out. So I like this strategy. The breakout strategy, breakout reversal strategy, where the stock has pulled back, now it's going back up and it's moving up with force. So and it's breaking out, it's reversing after pulling back. The third one is opening range breakout strategy, which I applied in Nike trade on Friday, and so this was the strategy I applied: opening range breakout, where you figure it out what the stock is doing within your defined opening range period, like 30 minutes or 45 minutes, whatever is your period, and then once you know that, okay, the stock is doing this, I will get in. So whatever is your period defined, 5 minute, 15. So I applied Nike, and I will show you the chart of Nike. Then there are 4 gap strategies: gap up, gap down, gap up reversal, gap down reversal. So sometimes the stock gaps up and then it reverses down. Sometimes the stock gaps down and then reversal takes place to the upside. So when the reversal is taking place to the upside after the stock gaps down, and it's sometimes it's so powerful that within 30 minutes you can double your option gain if you are at the right time, and it moves fast. So gap down and then the stock reverses. So why the stock gaps down? So this is you need to master. Or why the stock gaps up and then comes down. In the Nike case, the stock gaps up and then kept on going up. So these are another 4 strategies I practice every day. So, and there are other patterns. So give you the example of Costco. I missed this trade for put. So I regretted that I missed this down move. I got into, this was the day when Amazon announced Whole Food, and we bought TJX. So there were so many, Costco, Walmart, TJX, and others. So we bought TJX puts. I think double or maybe more than double our profit. So I just chose one and I missed the Costco. So Costco tanked like this after banging its head on the resistance. Now it looks like it's going up. So 200-day moving, this is the 200-day moving average, and it's being held. So 200 days is the day where the professionals or those who have money, they come and defend the stock, because below 200-day moving average, the stock is considered highly bearish, and above is okay. And so between 50-day and 200-day is like la la land. So not bearish, not bullish. But if you look at this chart, it crashed. So Costco crashed, but it's holding 200-day moving average. So your stop is below 157. So you can go long, hold 156, 157. Maybe it will dip to 156 and it goes up. So your risk is, so they are coming in at this price, and the risk they have defined, I think, at 156, and they want this stock to hold the stock. So maybe they're putting in new money, or the value traders, buyers. So what happened next? So let me see. Yeah. So Costco is, I think, is in the up move. It will hold this 200-day moving average. Number 2 is Goldman Sachs. So Goldman Sachs, if you draw this trend line, rising trend line from the lowest low of the last 7-8 months, this was the 216 is the support, and that's why we bought calls at this price, knowing that this is there is a support here. So this is the support area, and then let me go this way. Sorry. So so 216 was a strong support. So we bought calls. Then it moved up, but again it held the rising trend line, and then the announcement came. So positive, and Goldman Sachs, I think I don't have a chart. Maybe this is the chart. Yeah. So this is the move. So it gapped up towards 230. So I've been telling for my end of day surveys in the swing that the 230 stock will go up. 230 we sold before and made money, I think 200 per contract, and now it's coming back again. So if it holds 221, then it could be a buy again. So we will see. So Goldman Sachs is rising, and all the other financial stocks were moving up also like crazy. JPMC, etc., Citibank, etc. Next one is SSYS. So this, I send the chart and I send the trade. So when you see a gap down like this, where the stock is closing at the low of the day, it's bearish. So there is no support. The support is right here at 22 level. So this one is coming down at 22 level. So this gaps down and then coming here. So chances are high that it will come to 2172 price. And it is coming. So after that day, these 3 down candles is not doing much. It looks like they are coming to buy, but the chances are that it's coming here. And if you look at this rising trend line and this 200-day moving average, it's coinciding. So 200-day moving average is 2177, and this trend line is also 2177. So both are coinciding. So this is the place where SSYS is coming down, and probably it will hold here. So gap down, you can buy puts and hold till 21.77. So that's the logic. Next one. Okay, CBI. So look at this CBI. We made big money on CBI calls, and I still have some shares. And this is the example. So when the stock moves up like this on this volume, there's something called initial impulse. So when the stock puts its initial impulse move at the bottom, that determines its destiny. So look at this, from $14 it went to 1940 on this day, on 27th of June. So we caught this, we bought options at 60 cents, August 20 calls at 60 cents, and last it was trading at 355, 250. On Friday CBI came down, but I explained to you that this initial impulse has determined its destiny. So this is, the destiny is higher. So if you caught the move, we caught the moves in middle somewhere here, you need to hold, because this is bullish. So if somebody say no, CBI will come down, no, it's not. It has defined its destiny. So if you take from, suppose 1450 to 1950, it's $5 move. So this initial $5 move, you can add another $5 move here. So 1950 to 5 is what? 2450. So that's the target I gave you. That is going to 2450, and that's where I will sell my shares. So I don't care what they say or a news comes. I know it's going here. So once it crosses this 50-day moving average, 2187 is going here somewhere. So CBI is bullish, and I do have some calls also. So right now my calls are like 200%. I was up 400, 200. I sold some, and I'm still up 250% or so. So 60 cents has become $303.55 in 2-3 days. So I explain more. So see, it tried to penetrate at 50-day moving average, then it pulled back. So it's okay, it's normal. This candle is normal. This was bearish candle, but it's still, look at the move. If someone bought here and they bought somewhere here, they didn't sell here, they would sell here. It's still, it's just a pullback. It's nothing bearish. It's gonna go up and calculate the move. It's called measured move. So if you take this move and add another move on top with bunch of candles, so it will not be like this one big candle. It will be small candles, but it's zigzag, zigzag. It will go up. Just remember RH, how it did, and we made money on RH. Similar thing happening in CBI. This JD, now JD has become bearish. So there's a spinning top or doji candle. This was bearish, and then next day it fell. So this is a bearish candle, and JD can fall easily on 38 level. So this is the support here, 38, or maybe if it breaks, then it's coming down. So again, it's trying to hold this 50-day moving average, but if it breaks, it comes here, and if it doesn't hold here, then it's going to come down. This is the support here, this candle. So this candle is telling you that this is the support here. So when you're trading, you have to see on the left side. You have to go on the left side and say, okay, where is the support? So on the left side, if you go, here is the support. This tiny candle is saying is support here. This candle is support here. This is the support. If it breaks here, then there's 31 level for JD. I have a 6-month coaching program. You can send me email at Noshi at Financial Market Wizard for 40-minute strategy session. It's free, and we can discuss about 6-month coaching program. If you're interested, just send me email. Next is STX chart. So STX also bearish. It gave down from the resistance and it broke this support. So STX looks like if it breaks 39, it will come down. And if you go back to the left, then 35 is the support. So it's coming down. STX is coming down. Next is, yeah, so okay, so this is a gap down, and then it's it is coming down. See, it broke the support, so there is no support till here, so it's coming down. This Apple, so Apple, everybody loves to trade Apple. If I send 15 alerts and one of them is Apple, I guarantee that 100% of my members are in that Apple trade or Facebook trade or Baidu trade. These I don't know, something is magical that everybody wants to buy Apple calls or put. Oh, Apple trade, you buying calls? Okay, I'm gonna buy. Boom, buy. So Apple is like that. So Apple, this is a strong support here. So this, if you draw this line, this is the area of a strong support. So Apple right now is not doing much, but it looks like this is the support and it will go back up. So, and if it goes back up, it's gonna come here. So you can extend this line maybe at 160, 162. So Apple is, this is the strong support at 142, 143. So I am long on Apple. So it is doing nothing on this, just doing sideways move. See, this candle is holding it. It's holding this. You see all these tiny candles? So pay attention to the tiny candles. Now look at CRZO. So we bought calls on CRZO. We are up, I think 70, 80%. And this is the move. We caught on Thursday, 30th of June. So again, I drew this line and then I saw this. I said, okay, I'm going to buy calls. So I bought calls and we are up 70, 80% and going to sell somewhere here. Look at this big volume. You see this huge volume? So same kind of move like RS, CBI, etc. So when this kind of move comes, volume at the bottom, the stock has put on the bottom. So now there's no way going down, it's gonna go up. So we need to hold. So this is the area I will sell the options, shares. If it breaks, then I'll see where I can sell. So CRDO is going up. So something is going on. I don't know about news. People send me email, hey, what's the news behind? So I don't have time to look at the news. When this, I spot the stock, I buy first and then I look at the news. I haven't looked at the news. Why it's going up? So it's going up. So I know that by the time I try to look at the news and then see and understand, then the move is over. So I'm not looking at the news. So I'm just looking at this move. So shoot first, ask question later. MU broke down. So MU has been going up and this was earning. So this was a bearish candle and look at the volume on this and this. So it's pretty good volume. So if it breaks this 50-day moving average, then MU will fall. So I'm bearish on MU. Now this is the Nike chart. I think this is the last chart. So I explained to you Nike chart, and there are 3-4 things which you need to learn, and I learn and I watch, and I think I have pretty good handle on it. So when the stock moves up or down, and it's pre-market or aftermarket, you have to watch the action during pre-market or aftermarket. So Nike announced earnings after the hours. So I watched what it was doing, and then in the pre-market I was watching on Friday what it was doing. So it was trading at 56.32. I post on Facebook that if Nike breaks 56.80, then it's supposed to be long. So and I knew this is the resistance. So I would take chance on Nike and go long. So based on the pre-market action, it was holding well 56.30, and I said, okay, I need to see further confirmation and then I will buy calls. Look at the time I prepared the chart. I think it was 9:55 a.m. The volume, look at this volume. It's not much, right? And Nike gapped up. So how you know it's gonna go up or down? So I applied my opening range breakout strategy. I applied the gap up strategy. I had a pre-market, aftermarket observation. So when you combine all this and then put it into action, so I bought calls and I sent alert to buy, and I think we were up pretty good, 40-50%. and look at what happened to the volume. So you see this volume is not that much, right? And Nike is trading at below resistance. So this was another point where I said, okay, I'll buy more, and I sent alert that it broke. I gave you the resistance level, and I said that if it breaks 58, 50, 60, then it's going higher. So this was, I was looking at this. So I was looking at this, I drew this line, Nike was trying to break through, and this is what happened. You see the volume built up from that tiny cap is huge, and it broke the resistance. So when the stock is breaking some resistance, you have to go into the 5-minute chart and see what action it's doing. So I flip my chart into 5-minute, and I see I have 15 monitors at home. So one of the chart monitor is just for 5 minutes. So I watch on my 5-minute, and I saw the break. So now it's on a upward trajectory. So we are 50-60% up, and it's gonna go up. So we hold Nike. Now, one thing I need to tell you is this. Where is it? So I have a I think I moved my file. Let me open this file. So I have this awesome offer for those who are not my members yet. So this offer, okay, oh man, this offer I want to give you, and unless it's not opening here, and I will explain this offer. So if you look at the chat window, I gave you this offer, and it's for $17 only, and it's for those who are not yet member. So I'll explain what it is. It is $17 for the first month of swing option, and next month will be $117 instead of $127. So the offer is $17 for the first month, and second one $117 if you should choose to take my offer, and it's valid till tomorrow. So price is $127 regular, but you will continue with $117 and $17. So that's all I have. And if you're interested in 6-month coaching program, you can send me email, and I will send you the booking link. We can book the appointment, and we can talk for 40 minutes. I will explain. And the next webinar is on July 9th, 5 p.m. Pacific. All right. So I stopped the recording. I don't know how to stop the recording now. Okay, if I stop it, then it will stop the recording automatically. Okay, thank you. And you will also receive the link in the email for this offer in 2 hours. Thank you. Bye-bye.